Well, after days of trading jitters and sell-offs, Asian markets seem to be coming out of the dark and attempting recovery early this Friday. So what will this spell for both the PSE now and in 2019? Well, I'm joined now by Julian Tarrobago. He's the head of equities, that is, at ATR Asset Management. And to ask him how he's taking in all of the recent developments both here and abroad. And you can see Asian markets are looking rather healthy at the open so far, June. Markets from Sydney to Singapore doing quite well. But I did want to go back about 24 hours ago, when we saw the U.S. markets avert a near meltdown. You'll see here that the Dow fell by about 1,000 points at one point, and then suddenly pared back losses to about just 1.5%. Do you take more comfort or concern over what's happened in the U.S. in the last 24 hours and what this might mean for emerging markets like the Philippines?
I take more comfort in what's happening overseas, particularly in the U.S. right now. Mainly because there are, I think, strengthening indicators that the U.S. Fed will pause in terms of raising interest rates in the U.S. And what that means is that ultimately it could trigger a move back into emerging market equities and other risk assets. So that would be a tailwind for the Philippine stock market if the sentiment improves and flows go back into emerging market equities.
It seems that U.S. market sentiment is the conductor for global equity sentiment at the moment. And one thing that people are highlighting is what's happening in the fixed income space. This inversion, some inversions that are happening across the U.S. Treasury yield. You'll see here the spread between U.S. 3-month T-bills and 10-year bond yields also here. It's starting to come down, and as we mentioned before, when it hits negative, usually, it does signal a possible recession. Is this possible, and what type of headwind might this provide local markets should this come to pass?
It could have a bit of a knee-jerk reaction in terms of overall sentiment that the U.S. is, that there are indicators of a potential inversion of the yield curve. However, as I mentioned earlier, I think the ultimate effect of this is that the U.S. Fed will start pausing in terms of raising interest rates, and that would bode well, definitely for risk assets in general, and more specifically, emerging market equities, which would be a tailwind for Philippine equities.
So is the possibility of a recession in the U.S. actually a little far-fetched at the moment? Are we worrying too much over a yield curve that seems to be flattening, but really not? You're not really losing a lot of sleep over this.
Not really. I don't think I agree with your view, JP, that the recession risk is still maybe down the road. But the truth is the yield curve is flattening, and there's people who are actually thinking that there might be at some point an inversion of the yield curve, and while I don't subscribe to that soon or for the near term, I think the impact would be actually quite good for risk assets in EM equities.
All right, let's delve deeper into market strategy heading into 2019. And when you look at the fund screener on Bloomberg, and if I can get the camera to just zoom in here, I can't help but notice that the top 2 performing funds year to date so far in total returns happen to be under your house, ATR Asset Management. But when you look across the top 20 funds, you'll notice that it's a smattering of money market funds, short-term funds, and also diversified funds. And it seems that over 2018, when we've seen all of these headwinds and challenges in equities, it seems to have favored either conservative investors or diversified investors. Is this a fair assessment as to what themes have been working in 2018? And will this be the same strategy next year, or do you think there are things that are going to change? What strategies are going to be successful in 2019?
I think you put it very well, that the diversified strategy would definitely work in an environment wherein you have a very challenging equities market, such as 2018. And that being the case, our multi-asset strategies have actually performed quite well. In terms of in terms of the outlook for 2019, we think there still will continue to be room for diversified strategies. However, I strongly believe that given that the growth prospects are actually quite positive for next year, from a macroeconomic standpoint, from a corporate earnings standpoint, I do believe, and that the fact that as we mentioned earlier, that the external environment may actually be more constructive for 2019 for EM equities, risk assets, and Philippine equities, then I think a move back into risk assets, equities in particular, would be the right strategy for next year if you're positioning for 2019. And I say that because, as I mentioned earlier, from a macroeconomic standpoint, the Philippine economy will probably benefit from um, uh, s- still strong consumption spending, probably boosted by an election year next year. And also the recovery in consumption could also be helped by the easing of inflation. As you well know, the factors that have weighed down on Philippine equities this year, particularly inflation, the weak currency, and monetary policy uncertainty, and the sell-off in emerging market equities, these are factors that are slowly turning into positive factors. And I think these are things we can build on in terms of momentum for 2019. From an earnings standpoint, since you mentioned earnings also earlier, we're quite optimistic that the corporate earnings will grow by probably at least 10% next year on the back of recovery in consumption. And the banks will probably be one of the fastest growing companies for next year. You have the likes of BDO, which we have growing at about 20% in earnings terms. And this is on the back of a recovery in margins in particular. While we believe that loan growth will actually be slower, still growing, probably at 10 to 14%. But that would be but profits will be driven by an expansion in net interest margins for next year.
Now, when you look at earnings, actually, there seems to be two major themes that seem to be balancing themselves out. One, the side of inflation peaking is leading some optimists to say that margins might start to improve because of lower input costs. But again, higher funding costs because of all of these rate hikes might crimp. We've heard a number of CFOs from Metro Pacific Investments, Ayala Corporation, say that also. Net, do you still think that this is going to balance out in favor of earnings heading into next year?
I do. Dollar debt is not very high for local corporates. And while we have had more than 150 basis points in interest rate increases this year, we think that the debt levels are still fairly manageable for the local corporates, such that even if with higher financing charges next year, we think the overall impact on earnings will be overwhelmed by demand growth, top-line growth in particular.
Now, going back into the banks, we did see a report earlier on from ING that says that because of easing inflation, we might see the Bank Central resume to cut the triple R ratio from 18% by about 2 percentage points. Can you help our viewers understand more how this might impact the banking sector? Is this going to be significant, or is this going to be par for the course as they try to normalize these ratios?
I think it will be significant because banks like BDO, for example, don't need to go to the market because they'll basically have more funds to lend if the reserve requirement goes down. And that means they won't need to, there will be less of an urgency for them to go to do another stock rights offering, perhaps. And that is what the skeptics are pointing out in terms of in terms of their view on BDO stock. It's that they're probably going to do a stock rights offering next year. And we disagree. We think that this potential cut in the reserve requirement actually could mean less urgency for them to do a rights offering and still maintain a healthy level of loan volume growth.
Okay.
So,
let's talk about your call for the PSE year end in 2019. Just a quick check of how the local market is doing so far in today's open. You're seeing the main index still relatively flat, but overall you'll see also that the PSEI at least just coming back down to earth, it seems, from the strong first 2 days of this week. What's your call for the PSE at the year end and in 2019, given some of these macro factors and all these developments we've seen both here and abroad?
I think we don't really do short-term projections since we're like 1 month, less than a month into left for 2018. But over the next 12 months, I think you could see the index back to the January level of about was it 8,500?
I believe in January 26th it actually hit 9,050. I think. Are you?
I won't go as far as saying 9,000,
okay,
but maybe 8,500 is a more realistic target, and that's simply aligning the PSEI to the historical price earnings multiple. The outlook, though, is tempered by what we think are lingering risks in the market. I mean, while I'm very constructive on the growth aspect, there are issues also that still need close monitoring, such as the current account deficit, which is at about 3 or close to 3%, and that intuitively, if not addressed, if not managed properly, could result to some volatility in terms of the dollar-peso rate, and that's something we're closely monitoring. But that side, we think that an environment of renewed growth, consumption-led, possibly investment supplemented in the second half of 2019, and easing inflation all make for a very constructive view on Philippine equities.
Nevertheless, though, before I let you go, June, you did say that diversification is something that everyone can always use a little more of. How would you advise the typical Filipino investor if they wanted to achieve more diversification for their portfolios in 2019, just to buttress or try to protect themselves from some of these potential headwinds that you highlighted?
Well, we're advocates of diversification, and it's really finding out or determining a healthy risk of fixed income and equity and alternative investments that would suit their particular investment objectives and fall within their risk levels. And the best thing to do is consult a fund manager. And to worry about all of those things for them.
All right, this is sound advice from Julian Tarrobago, the head of equities at ATR Asset Management. Thank you so much for joining us this morning
Thank you,
to help us kick off the markets on the last trading day of this week.